So recently my friend has gone into buying a house and I've really just spent a lot of time learning about mortgages and I just want to share what I've learned. So without further ado, let's talk about mortgages. So what is a mortgage? It's pretty much a huge loan. Think 25 to 35 years. And you're only thinking about it when you're buying a house. But how do you qualify for a mortgage? That's our question. Well, first thing, we need to look at our credit score, a number between 0 and 1,000. To improve your credit score, you pretty much need to pay your bills on time. And really, if you want to qualify for your mortgage, then in general, your score should be greater than 600 points. The second thing that we want to worry about when want to qualify for mortgage is our income. Two pay stubs and a letter of employment to prove that we have income. Third thing is assets. That's basically our net worth and our savings. The fourth thing is our total debt service ratio. It's basically for lenders to give a little assessment of how we are with our debt. You could also call it TDSR. Basically, if it's to find out whether you're in too much debt and whether you're crazy trying to buy a house. And there's actually a formula for this. It's annual mortgage payments plus property taxes plus other debt payments all over gross family income. So these variables will determine whether you're crazy and trying to buy a house that you cannot afford. You want this as low as possible. 40% is our benchmark. The fifth thing is our down payment must be at least 20% or more. The next thing we want to go into is Canadian Mortgages and Housing Corporation because I'm a Canadian. It's basically where the federal government insures the lender, and really the price is calculated when you apply for your mortgage. The lenders pay it, but those assholes really just pass these costs to you. So really, the borrower or you is the one that pay it. It's calculated as the number, as the percentage of the loan, and is based on the size of your down payment. The smaller down payment is, the higher the premiums, and really, if you pay for your monthly payments, interest plus principal plus insurance premium, then that really is a lot higher. So before you actually go and buy your house, the rule of thumb is to always make sure your down payment is at least 20%. Because what happens when your down payment is not 20%, then they really just charge this insurance premium that they have here. And it really just makes it that much harder for you to pay down your principal of your house that you're trying to pay down and live off of when you retire. So really, this is really something that you would want to look into if you're a Canadian. They also have the same thing in the States, I believe, and it really is something that you should take into a look into account before you actually buy your house. But really, if your down payment is at least 20%, then you wouldn't have to buy this mortgage loan insurance cost. And that's a really short video. Hope you learned something about mortgages. And please subscribe. Maybe we'll learn something more about mortgages, and we'll see you next time. Thanks for watching.